I'm gonna call up Ali's gonna show up here. He's gonna be the one teaching. Now, who is Ali? Ali is a good student. You want to see my whiteboard for a second? Yeah, sure, of course. Hold on. Ali is a financial analyst, just like me, except that Ali has an area. Oh, I don't know how to change that, but anyways, let's just do this for now. Let me just introduce, and then Ali can take over. So Ali is a financial analyst like I am. I am a holistic financial analyst. So I look at the market as a whole. Ali is also a financial analyst. He's forced into the holistic approach because I forced him into it. But at the same time, I refer to him as the master of cryptocurrency. I don't know if he likes it when I say that, but I just refer to him as the master of cryptocurrency. Self-motivated, highly principled professional, with years of experience in startup projects and years of experience in cryptocurrency. You guys understand cryptocurrency? Like, I don't understand cryptocurrency. At least, like, cryptocurrency means like Bitcoin and the other funny one, is that called Dogecoin? Bitcoin, all of this stuff. I don't understand it. Now, based on the principles of what we've learned from Charlie Munger and Warren Buffett, if I don't understand cryptocurrency, should I be investing in it? Yes or no? Nope. So I haven't put a single penny in it. He understands it inside out. He's not going to talk about cryptocurrency. He's going to talk about, but I wouldn't. I would never invest in it. Why? Because I don't get it. And me and Ali have hit heads so many times on this. It's hilarious how we do it. But because we're good Muslims, we're still going to eat lunch at the same table. You get it? We're still going to eat lunch at the same time. We're not going to be like, oh my God, you invest in cryptocurrency, so I hate your guts now. And he's like, oh, I hate your guts, so you don't. No, we're just awesome that we just do our own thing. Master of cryptocurrency. He's certified blockchain expert with 8 years of experience in cryptocurrency. Just like myself, he's also studied under a high-performing hedge fund manager and a PhD in economics. He's studied directly under them. All right. So he's gonna show up, and inshallah he's gonna give you guys he's gonna teach you guys about this next major area, which is well, I'll let him take it up. Go ahead, Ali, and I'll just clear the whiteboard.
Okay, Bismillah ar-Rahman ar-Rahim. Can I share a screen?
Yes, of course. Go ahead. Right in the bottom.
Okay. Right here should be. Can you guys see what I'm looking at?
Yep.
Okay. Yep. Hopefully you guys can't see the Zoom chat, but I can. Okay, so let me pull this into full screen. So the Sheikh, Barakallah Fiqh, you did a very good job introducing me. So I'm just gonna jump right in. Inshallah, my presentation is on inflation and crashes. So we talked about the four-pronged strategy, which is the first step is personalization. What does the company mean to you? You know, do I actually shop at this kind of a company? Why am I even interested in investing it? Then we talked about the ethical aspect of it. And then there's the management, the moat, and then finally you put a price on the company. So all of that is going to come in due time. But in order to implement this strategy, first, you kind of have to understand what's going on in the market. You know, you can't implement a strategy just in abstraction without knowing what you're actually dealing with. So let's go ahead and look at the first slide here. So we're going to talk about three things here. First of all, we're going to talk about inflation. Then we're going to talk about events. And then we're going to go over some of the personalization homework that the Sheikh was referring to. So before we get started, I just want to ask, what is inflation? You guys can put it in the chat. What do you think inflation is? Just give me a one-line summary if anybody knows about it. When a company booms, money loses value. When price of goods increases, percentage increase, lower purchasing power. All of those are great answers, and they all fit into what inflation is. So the question is, how do factors outside of a company's control affect its value? Because the stock market is not just companies living in bubbles. Oh, this company is doing great and that company is doing bad, and it's just because of the people that work in the company. There's all kinds of other things that come into play that affect the market, that affect the value, and that ultimately affect what our strategy should be as investors and how we go about doing things in order to maximize our returns in an ethical way and based on companies that actually have some kind of intrinsic value. So when we're looking at the market as a whole, that's called macroeconomics, which I missed an O there. Sorry about that. Macroeconomics. Macroeconomics is looking at markets as a whole and trying to understand the broad strokes of how things move and how things work. So it's a in-depth field of study, which we don't really need to get too in-depth into it, but we do have to understand some basic things. First of all, we have to understand the basic economic model that we're dealing with as investors. So that's capitalism. I think everybody here has heard about capitalism and understands the very basics of it. It's the most popular economic model in the world right now. And just like the name suggests, it seeks to produce capital. So this is a very important but often overlooked point. The purpose of the capitalistic model is to produce capital. It's right there in the name. Capital is money. So the purpose of the model is to produce money. So now we have to ask ourselves, how does it produce money? And what does that money mean? So the primary way that money supply increases is through interest. And we're going to get a little bit more into what interest is and where interest comes from momentarily. But one of the main ways that interest is produced is through something called fractional reserve banking. And this also goes directly into crashes and events. So there's a direct relationship between interest and crashes and events that we're going to kind of explore and look at. So interest is, let me see if I have I do, or I'm saying interest, I mean inflation and interest. Well, they go together because inflation occurs due to interest. Interest is a prime way that the money supply increases, and that's through fractional reserve banking. So what fractional reserve banking is started from the Bank of England. And what it is basically banks are allowed to loan out more money than they actually have. Banks don't loan out just based off of like, okay, I have $100 that I actually own, I can loan it out. What they do is you put your money in a bank and they pay you a certain percentage. And what they get out of it is that they're giving your money to other people who are in return paying them a higher percentage. So what ends up happening simply is that more money ends up being loaned to the bank than that actually exists in the money supply, than the government ever printed. And what this does is it causes something which are known as bubbles, which we'll get into a little bit more. So inflation. What is inflation? Inflation is a currency's decline in purchasing power. So over time, how much a currency can actually purchase. If I have $1 today, and then if I have a same dollar bill 10 years in the future, am I able to buy the same amount of stuff? Well, usually no. In a capitalist system, no. And we're going to get into the details as to why. The reason why is inflation. What happens is the currency declines in terms of how much it can actually buy. And inflation just describes a devaluation of the currency. So what we have are dollar bills. These dollar bills, they used to a long time ago they were tied to gold, and now they're pretty much not tied to anything. So because they're not tied to anything, their value is pretty much determined by the central bank, what they can purchase. So why is deflation avoided? Deflation is the money actually becoming stronger and you can buy more with your money. The reason why is because deflation is disastrous for central banks, and it's disastrous for fiat-based markets. Fiat is when you have paper money as opposed to money which is based in precious metals or cryptocurrencies or something else. The reason why is because it raises the possibility that the overall market will become worthless. Why? If a central bank does not intervene in your money devaluing and continuing to devalue, eventually the purchasing power of the money will just continue to increase, and the value of assets in relation to the money will continue to go down. And eventually this can cause your markets to basically become worthless. Central banks tend to inflate fiat values no more than 10% per year. They do that in order to make society feel like everything is going well, the economy is burgeoning, things are moving forward, but not so much that, 1 year, wow, I could go to McDonald's and get a burger for $1 and now I need $10. That would be too extreme for people. People would have a sense that something's going wrong. So it gives the public time to adjust the prices while also believing that the economy is growing. And it's important to note that it doesn't actually matter if your economy is doing any better. It just matters that the market is going up because the value of money is going down. So you look at the market charts and overall the market is going up. So you feel like, wow, the economy is growing. It doesn't really matter if any of those companies are actually worth more. It just matters that the chart looks good. And that fulfills capitalism's promise, like we said, of making more money. So I know I just said a whole bunch of stuff. If there are any questions, anybody wants to ask anything, do a small pause right now. It doesn't look like it. Does that make sense? The basic premise of it? You guys can let me know in the chat. Okay. So why are bull markets important? Commodities and indices, which we haven't got into indices, which are managed by central banks, historically always return to a bull market. They always go back up to a bull market. A bull market is as opposed to a bear market. A bull market just means it's going up, and a bear market just means it's going down. That's it. So what ends up happening is you have situations where all of this interest that is put into the financial system, which causes all of this inflation, which weakens the dollar, it creates something called a bubble. What happens is the banks loan out more money than they actually have. But it reaches a point where all these banks are loaning out more money than they actually have. And because of online banking now, they literally just make up money that doesn't exist virtually. They don't have to actually print out money. What happens is there's all this non-existent money that's loaned out and interest. Eventually, it reaches a critical point where people start calling the bluff and they want to get their money out of the banks and put them into other assets. This is the main way that crashes occur. They're caused by various reasons, which are not really that important and outside the scope of this, but this is pretty much what happens, and this is what is referred to as a bubble, and the bubble pops. That being said, when the bubble pops and the market hits a low, what you'll see is the reaction of central banks is that they continue to inflate. And you saw that with COVID, with how the US government printed so much money. The market will hit a low, and the government wants to make sure that the market doesn't end up crashing with respect to the dollar. So what they do is they inflate. They put more money out, they give more generous loans, so on and so forth. So eventually the market will hit a low. And when it hits that low, now the value of the currency is being depreciated by the bank, which means that the value in terms of the chart of whatever market we're looking at, whatever the stock market, is going to have to necessarily go up because now it is worth more than what the dollar just was worth a couple of months ago because of the inflation that they put out. So when it hits a low, you know that eventually, because of what they're doing, it's going to find a new all-time high. That's the next step. So what does that mean for us? All of this, convoluted macroeconomic jumbo mumbo. What it means is that investors as a whole stand to profit from the market. If you are in the market and you just sit there and you don't do anything, you stand to profit from it, as opposed to holding money. If you hold cash, then you stand to lose because the central bank is going to try to devaluate it in order to make the market more valuable, because this is the entire premise of capitalism. So long as the economy is managed by a central bank, the currency can be expected to inflate and the value of the market is increasing. Inflation is necessary for markets to continue to reach new highs, as we explained, and it generates positive emotional responses, which encourages spending and encourages people to take on debt. Okay, so that was the premise of inflation. So now we're going to get into events. So I want to read a little bit from an article from Fortune magazine that is particularly interesting. So this article is called How to Spot the Next Financial Crisis. Let me make sure you guys can still hear me. Okay. 10 years after the weekend that upended the financial world, its most important lessons lie not in what has changed, vast and profound though that is, but in what hasn't changed. The main causes of the last crisis, human self-delusion and irrationality, will be the main causes of the next one. If that seems unbearably depressing, cheer up. It tells us what to watch out for. Lehman Brothers' bankruptcy announcement in the pre-dawn darkness of September 15th. Let me switch to the next page here. 2008 wasn't the first or worst event of the financial crisis, but it was the most frightening because it was unthinkable, given the investment bank's size and exalted stature. It unmoored us from our certainties and set the stage for other disorienting changes, many of which are now embedded in our daily lives. But those same certainties were built on foundations that turned out to be unfounded. We all knew that the United States home ownership rises over the long term. That's part of what America is about. The unshakable confidence helped fuel the easy credit home buying frenzy of the early 2000s, a frenzy driven by the belief that an unprecedented spike in property prices would last indefinitely. Big institutional investors, including Lehman, bought into the faith-based rally, betting on the kinds of shaky subprime loans that eventually brought them down and created the economy. As for the home ownership rate, it plunged, erasing 40 years of increase and is nowhere near recovering. If delusional optimism led to widespread financial harm, delusional pessimism has kept many Americans from healing. So what you see is that the stock market is very much so about ego management. It's about how do we feel and how that plays back into the markets. It's not so much about just objective pricing and the value of companies. There's a huge psychological aspect to it. And when we acknowledge the psychological aspect, we can use it for our own benefit. Yeah, sorry, I wasn't sharing at that time. I was not looking at the chat. Okay. So hopefully you should be able to see my screen now. Okay. So did that passage make sense? Are there any questions about that passage? Okay. So what is an event? An event is something affecting a company's value, which is not directly related to its intrinsic value. It's something which changes the price of the company without something actually affecting what the company really is worth. So there are things which affect what the company is actually worth in terms of intrinsic value, in terms of, okay, it makes this much money, it has this many employees, it has this kind of property, it has this many debts, it gives out this many loans, it has a great product. All of that is the intrinsic value of the company. Then there are things which are outside of the company which can affect its price. So really being able to comprehend and understand events is kind of beyond the scope of what we're doing here. It's more of an intermediate analysis tool, but we're going to go over it broadly just so we can keep these things in mind as we move forward. So one of the questions that we have to ask is, can a company withstand an event on its own without government interference? And this is the concept of a moat, which will be discussed, inshallah, a little bit later. So we have to be able to look for events before they happen and also historically, and have to understand them while they're occurring in order to be able to benefit from them. And we have to check for events when we're running numbers. Sometimes events are positive and sometimes events are negative. So I'm going to stop screen sharing for a second because I want to show you guys some charts. We're going to look at 3 charts real quick and just kind of see what an event looks like, because we all know what an event looks like on CNN and Fox and whatever news that a person likes to look at. We all know what an event looks like there. Oh, the Dow is down this much, this happened, financial crisis. But what does it look like when we're actually looking at a company's chart on the stock market? So what I'm going to do is I'm going to open up a chart and then I'm going to start sharing it again. Just give me 1 second. We're going to look at Tesla just because it's a popular company, not because it's a good one, because I don't believe it's a good one at all. I actually really dislike Tesla. I think their cars look really nice, but other than that, I don't think that they're too great. Okay. Share screen right here. Okay. So what you guys are looking at here is Tesla's chart. Let me see if I can minimize this right here. Okay. So this chart is kind of wonky. There we go. So, oops, that's my little problem. Give me 1 second. I'm gonna close this door and get him out of here because it's making a whole bunch of noise. Sorry about that. I see there's a question. Can we predict if our company be like Enron or Lehman Brothers, since cooking the books will only be known later? Can you elaborate a little bit more? I don't think I quite understand your question. And this is not Thinkorswim. This is a different one that I like to use for charts. Thinkorswim is good too, though. This one I'm just using it just for the simple chart. So we're looking at Tesla here, and we can see that it was rising. Then there's something that happened here. So there's something that happened between the October of 2020 to November that sent it into this crazy upward swing. And then there's something that happened here that caused it to retrace like half of the swing. So when we're looking at Tesla, that's going to be something that we're going to want to consider. There was some kind of a positive event, and then there was some kind of a negative event. This insane chart that has to be one of the craziest possible charts that you can look at. This is, can anybody guess what this is? You can probably see it. No, not Reddit. It's related to Reddit. Yes, this is a GameStop. I'm just using this because it's incredibly interesting. So we see that GameStop was a very cheap company, like worth $18. All of a sudden, something happened in early January of this year, and it went up to over $300. So if I was just looking at GameStop and I wanted to invest, I would really be concerned as to what on earth is causing this company to have these wild swings. And then we're going to look at another one that went bankrupt. Oops, didn't pop up. Let me see. Here we go. So this is an example of I see you guys really are into this GameStop stuff. This is another company that really is very problematic. This company went bankrupt ultimately, I believe. I don't know if the chart is still going. This is Luckin Coffee. This is a Chinese company. So we can see that it went up really high. This is actually somebody was asking in the chat about cooking the books and things of that nature. This is a company where that actually did happen. It was a Chinese company. So this, you see that there's an event here. There was a great event. It went up, and then there's something that happened here. So I'm gonna stop screen sharing, and then we're gonna go back to the presentation. So we see that events are very important because they affect that value of your investments to an extreme level. I mean, we see that, could someone or something influence this on purpose? Yes, events can be man-made. Events can be environmental. Events can be a lot of different things. The different kinds of events are kind of out of the scope of what we're doing right now, but there are a lot of different kinds of events that can occur. So we want to focus more on economic disasters. Economic disasters don't actually permanently damage the value of strong companies. They can be a primary setback. So we talked about the bubbles, the way that the bubbles work, that there's inflation, which puts all this fake money into the money supply, and then it gets called back, and then there's no way to pay for it. So it causes a crash, so on and so forth. And this can also happen not just cyclically, but like with something like COVID. So COVID caused so much fear, which is the reason why these crashes occur at the most fundamental level. We were talking about how it's all about the human ego. When people have a lot of fear, then this is how the markets react. COVID kind of forced the envelope for an overdue crash and for the popping of the bubble. And then you saw the subsequent inflation by the Federal Reserve of the United States and in other countries, which buoyed the economies. So economic disasters don't normally permanently value the value of the company permanently, unless there's something wrong with the company, period. Then it kind of needs to be weeded out. Usually these disasters don't last any longer than a few weeks or a few years. But what they do is they're entry points for us. When we're looking at different companies and we like a company, but the company is just, it's overvalued. It costs way too much for what it is. Like the video that we were looking at with Warren Buffett and Charlie Munger, that they wait an indefinite period of time before they'll buy something. So they might have a company that they like, but it's just not discounted enough for them. It's not at a price where they can justify buying it. So what they'll do is they'll wait for an event, either an individual company event or a mass market event that doesn't actually affect the value of the company. The company's still strong, just it went through a temporary hiccup. And then this allows you to get into the company because you know this is a strong company. You already determine what the company is worth. And now the company is being sold at a price which is less than what it's worth. So you have a firm belief based on your research that the company should be worth more and the market is undervaluing it. This is when you can jump in and use that as an opportunity. And then this is how you can maximize your gains in an ethical way and still owning companies that you want to own. Would a stock split fulfill that? I think a stock split is kind of a little bit beyond what we're talking about, but stock splits are used for various purposes that do affect the price of the company and sometimes can be entry points. So that is something which we would look at. That is an event that it's kind of beyond the scope of what we're talking about. We're not going to talk about specific kinds of events. So how can we see events? We can check news and we can look for, on the news, you're going to see major events, usually that affect the entire market. Normally on the general news, you're not going to see industry specific or company specific events unless it's something that's really crazy. But you can always look at more specialized news that talks about, like, you know, the tech industry or the oil industry, whatever. And there's different kinds of events. There's the major events, then there's industry sector events, and then there's individual company events. So we use these events as entry points. So that brings us to kind of our overarching strategy for what we're going to do. So we want to maximize our gains and we want to benefit from the way that the market is set up and how it works. So we know generally how the market is going. We know that based off of how capitalism is, there are going to be periodic crashes, period. It's just built in. That's how it is. There's going to be another crash. And we also know that by holding on to cash, that we stand to lose because the cash is going to be devalued. And we also know that assets in the stock market are going to necessarily become more valuable over time. So what we do is we take a multi-pronged approach. We understand all of the stuff that's going on, but we don't put ourselves at the mercy of these market events. What some people do is they will either just wait forever for a crash to occur, which is not a wise strategy because now your cash is devaluing in the interim. Or what they'll do is they will try to ride the swings of the market on a short or a midterm, which we're going to get into that a little bit more. All of that neglects the fact that the market is a psychological and ego game for those people. And that's not what we want to do. We want to avoid that. We want to have a very mature approach, which doesn't involve that kind of reactionary or fear or excessive hope that leads people to make unwise decisions. So we want to take advantage of inflation by owning assets which will appreciate in value. We have to have a very stable methodology that includes both objective aspects and subjective aspects in order to determine whether or not the asset is going to increase in value. There's no way to really be 100% certain that a particular stock is going to go up. That being said, there's no way to be certain that any business deal that you do or anything that you purchase is going to appreciate in value, whether it's a home or gold or anything of that nature. What you can do is you can do your due diligence and a significant amount of research in order to position yourself in a place where, based off of historical data, it seems very, very, very likely that it's going to go up. And the more doubt that you remove, the farther away you get from speculating or gambling, which is one of the main things that we need to take into consideration. And we want to use events by utilizing them as entry points for overvalued but valuable assets. So an example that we went over in one of the previous classes was Chipotle. I think everyone here is familiar with the E. coli scare that Chipotle had a couple years back. So I'm going to ask you guys a question. Chipotle had a supplier that had some faulty vegetables or whatever that were contaminated with E. coli, and they served it to some people. Is that the kind of thing which fundamentally affects whether or not Chipotle is a good company or not? Okay, so you guys have kind of grasped it. Madiha says maybe. Why? We're going to ask Madiha why she says that it's a maybe. Well, while she's typing, because it is unpredictable how people may react to the event. Yes, that is true, but that how people react to the event doesn't actually affect the inherent value of the company. But you are 100% right, and we're going to talk about that now. So you have two perspectives here. Most people are looking at the market based off of fear. Exactly. It will affect whether or not they invest in it. You're 100% right. Most people are looking at the market on a moment-by-moment basis, fear. They look at their account, they see a 10% loss, they want to exit, so on and so forth. They're not looking at it with a very level-headed, long-term approach. They just want their money to increase right away without thinking about how exactly that works and what it needs to look like in the long term in order for that to actually happen. So the E. coli situation, it doesn't affect really the amount of employees that Chipotle has. It doesn't affect their assets. It doesn't affect their real estate. It doesn't affect their recipes. It doesn't affect any of these things. It affects the news cycle for a very small period of time, and that people will talk about it for maybe a week or two at the longest. And at worst, maybe one person gets sick and they have to settle it out of court for a little bit. But what it does affect is it affects all the speculators and the gamblers who want to take advantage of the fact that something bad happened and either remove their positions or bet that the price of Chipotle is going to go down, which it definitely is going to go down because of something like that. But if you know the company is valuable, then you're not going to look at this as, oh, Chipotle sucks, let me get away from Chipotle. Where you're going to look at it is, I know this company is inherently valuable. I've already done my research on it. I like the company. I was just waiting for an opportunity to be able to purchase the company. Exactly. The company is durable. So you determine the company is a durable one, but just at the current price, it doesn't make any sense. It's overpriced. So an event comes like this, which you determine, okay, this is just a temporary event. While everybody else is reacting with a fear-based approach and an emotional-based approach and an ego-based approach, you're looking at it as, okay, well, now it's on sale. And you're going to go ahead and buy the company. And guess what is going to happen a month, 2 months, 3 months, a year after this temporary thing passes by? Is going to go up. Exactly. You already determined that it's a valuable company. And now you got your entry point. So this is how you benefit from events. This is how you utilize events in order to position yourself in such a way where you can take advantage of the irrationality of other people. So Warren Buffett, he said, the stock market is a device for transferring money from the impatient to the patient. And that's very true. What if it goes the other way? What if the company does not recover? Well, you can ask what ifs about almost anything in life. What if you start a business and it doesn't work? What if you get a job and they refuse to pay you your salary? What if, what if, what if? What you're going to do, Madiha, is you're going to limit the possibility based off of, historical data and research that the companies that you select are going to go down. And you're going to do that through fundamental analysis, through analysis of the management, through subjective analysis, through looking at the moat, and finally through valuing the company. So when you take this multi-pronged approach, you limit the likelihood that you're ever going to select a company which is just going to continue to devalue. I don't know if that makes sense. You can never be 100% certain about almost anything in life, but what you can do is you can remove all of the unknown variables to the point where you personally are so confident and you love this company and you want to be a part of the company that you don't mind riding whatever small disruptions occur in the price. You have to realize that it's not just about making money just in an absolute sense. It's not like, I'm just going to work at McDonald's and I don't care about McDonald's. I'm just here to get a paycheck. You're going to pick companies that actually mean something to you, that you don't mind owning, that you feel proud to be an owner of. So if it loses some of its value, it doesn't really perturb you too much because you actually believe in the company. Okay, brother Furqan, he said, so you took that opportunity where everyone else was quote unquote scared about shares. Now when it has gone up, you benefit. Exactly. That's the most basic distillation of it. Obviously, there's so many more factors and it's very deep. And you guys, inshallah, if you decide to get into that advanced class, you're going to go into it more. Sajida says, it also depends on how big the event is too, isn't it? Yes, it does depend on how big the event is and what kind of an event it is. And it also depends on how it affects other companies. And it also, there might be things which are unknown about the company which come to light due to an event. So an event could be an entry point. It doesn't necessarily have to be an entry point though. What happens is when you learn how to analyze companies properly, you are going to spend time just going through companies which you already either frequent or you like their products or you admire them or whatever. So you're going to have a list of companies that you're going to be watching, and you're going to determine prices for all these companies. So for example, I determine that Apple is really worth $75. I'm only going to buy Apple at $75, but Apple's at $152. So I'm just going to have them on a watch list, and I'm either going to check them daily or weekly or whatever. Eventually, let's say I have 10 companies and none of them are coming down to my price. One day I see Apple's at $80. Now I'm going to look, okay, what happened? Apple had a change in management. Is this a rational reason to withdraw from the company? Does it affect any of the previous research I did that the company is valuable? And then if you determine that, okay, this is just a temporary situation, or it might even do some damage to the company, but the damage is not that serious. It doesn't justify the level of depreciation that's gone in the asset, and you still believe that it's going to go up, then you can utilize it. Okay, Asad Ali says, if it's a positive event that inflates the price like crazy, is that a time to sell? Yes, this is the opposite aspect of it. So in addition to determining a buy price, you're also going to determine an objective sell price. And when you study stock life cycles, every stock or every asset has a period of irrational growth that it doesn't ever compare to. The only exception that I know of is like Apple, but that's because Apple is a company which has been so big for so long and it went through so many management changes. It's arguable that it was like almost two different companies at two different times. But anyways, every stock has some period of just irrational growth, and then it goes down and then it grows more naturally. Like look at Tesla. Tesla just recently had that insane period of growth that didn't make any sense, was not based off the financials, and then it fell to about half of its price, which is a lot more reasonable. Still not reasonable, because Tesla really has poor financials, but it's a lot more reasonable. So when you see something like that that's happening, where there's an event that causes it to just be totally untethered, and you know that the stock is just way overvalued, then you should have already determined a sell price, and then that is going to be time where you're going to start considering an exit. Okay, like a COVID-related dip in market would have been a great entry point. Yes, it would have been a great entry point. Okay, so fundamental analysis. Fundamental analysis, this refers to the basic details of the company, which is kind of what we are going to get into at the end in terms of our homework. What is this company? What does it mean to me? Where is the company located? Who is the CEO? What is the price of stock? What is the market capitalization? These are just the most basic things that you can possibly know that you need to know. Then there's subjective analysis. What does the company mean to you? Why am I even interested in this company? Does it fit into your area of competency? So if you just totally do not understand, let's say automobiles, you don't get cars, you don't understand why people are interested in cars, you don't understand the mechanics of cars, you can't even recognize different brands of cars, you just have no interest in cars. You really should not have a whole bunch of car companies that you're looking at investing in, even if they're great companies. Why? Because they're outside of, or cryptocurrency, because they're outside of your scope of competence, of your interest. It's not possible for you to be passionate about this company. Now you're just kind of playing a numbers game, which when you start just playing a numbers game, you start moving further away from your ethical standards and also from your personal Islamic standards. And this is the opposite of what you want to do. When you determine what a company is, you have to really ask yourself, do I want to own this company? When we're looking at the market is a market. It's a marketplace. Sometimes we forget about it because we see these people in suits and talking heads on the television and all these complicated charts and all this stuff. It's a market, just like a vegetable market, just like Walmart, whatever. You don't go into Walmart and buy something that you don't eat or that is against your values just because you think that is going to be more valuable or that you can resell it. So why would you go and do that in the stock market? We have to have this, we have to get rid of that disconnect that's there. The company has to have some kind of a meaning for you, even if it's even if it's a great company and it's undervalued and there's an event. That doesn't just mean that we should just jump into the company without any consideration as to what is the company actually doing. Is it against what I believe? So on and so forth. Because you are now a part of this company. You are a partial owner. Sajida says, putting our heart into it and not just the money. Yes. Management, integrity and talent. You want to look at, and there's objective ways to determine management as well. You want to determine, are the people running this company people that I believe in? Are they people who are qualified? Are there people who I feel comfortable giving them my money? If I had to give them all of my retirement savings, could I trust them to do that? Because as the Sheikh was discussing about the concept of generational wealth, one of the problems that we tend to have sometimes as immigrants from other countries is we haven't really tapped into this idea of generational wealth. Sometimes we don't leave enough for the next generation in terms of assets or things to really kind of put them on the next foot forward. And we kind of want to change that. We want to have a different mindset, a different mentality to give our children and the next generation more of an advantage than what we had. And we can't do that if we're trusting our money to people who we don't even know who they are or whether or not they're even competent, just because our friend told us, oh, hey, this seems like a great company. So we go in and log into an app and put some money into it. No, you are going to actually own this company. You are going to be a part owner of this company. You're going to have privileges as a result of that. So you want to make sure that these people who are basically under your employ are people that you really trust to manage your money and this company and the assets. So this is our general strategy. The last thing that we really have is personalization, and then we're going to talk about questions, and then we'll see if there's anything else that we really need to get into. So I just want to kind of recap what we went over. We discussed that there's something called fractional reserve banking, which is the way that pretty much all of the banks run in the West and in most countries now. under the capitalist system. So the capitalist system is seeking to create capital and is seeking to create wealth. And it does that through inflation, which is created by interest. And that is done through fractional reserve banking. So what happens is, let's say there's 5 people with $20 and they go to a bank and they give the bank their $20. The bank then promises them, hey, look, I'm going to give each one of you guys $5 back for every year that you keep your $20 here. So the bank now has $100, but all of that money belongs to somebody else, and now they owe out $5. So now the bank is down negative $5. It has $100 that it doesn't even belong to it. Now it owes $5. What the bank does is, after those 5 people walk away, it turns around to another 2 or 3 people and it loans each one of them out $20. So now the bank has lost $60. So now the bank actually is down $65. They have $40 in their reserve and they have the $100 that belongs to somebody else, but they've loaned out $60 to these other people. But what they do is they tell these other people, look, you have to pay us back $3 at the end of the year. So the difference between what they're getting paid from the other people and what they're paying in interest to the people whose money they're holding, that is the profit of the bank. So we see that this is very problematic, because what if the 5 people who put their $20 in all want their money back and the bank only has $40 there? And meanwhile, the bank is going to give each one of those people their $1 from the $40 that's left. So at the end of the year, they'll have maybe $35 left. The money which they have to pay, they make other people pay for it. Yes, if they make other people pay for it in terms of the interest that they get from loaning it out. So if they owe the 5 people, let me see if I can draw. Let me open up one of those whiteboards so I can kind of draw it out to make a little bit more sense. Okay, can you guys see the whiteboard? Okay. This is the bank. Oops. Okay. Each one of these circles is $20 that an individual owns. They all give it to the bank. The bank now has $100. But this $100 doesn't belong to the bank. But what it says is, at the end of the year, I'm going to pay out $1 to each person in interest. So that's going to be negative $5. But this $100, it doesn't really belong to the bank. So, but we'll just leave it there. So the bank is going to have to pay out $5 to these people. Where is it going to get the $5 from? What it's going to do is, behind their back, it's going to have 3 people. Oops. Draw. Undo. Redo. Draw. Okay. For whatever reason, it's still doing text. Anyways, we'll just type it out. So there's 3 people over here. There we go. We're just going to draw them as lines. There's 3 people over here, and it's giving each one of them $20. So now the bank is down $60. You can annotate. No, I'm sorry, I don't have to screen. I'm on my laptop. So now the bank is down $65, and there's a $100 that it doesn't own. What they do is they'll tell each one of those 3 people, look, you got to give us back $3 at the end of each year for this loan. So now they get $9. Now what they do is, this $9 that they've gotten and the negative $5 that they owed out, they just subtract them. So now, in terms of interest, the bank has made a positive $4. This is their profit. The problem with this is obviously the numbers are not going to be that small. The amount that they're going to pay in interest to the people that they're holding their money is way lower than the amount that they're going to charge. So they're going to make a lot of money on the interest in between. The issue with this is that, let's say these 5 people decide, you know what, we don't want the interest, we just want our money back. The bank has to find a way to pay out $100, and they have the $4 profit that they made. They have minus $60, so we're at 40. So they have $44. So now the difference between what was originally given to them and what they have is $44. So the bank has to come up with $56. This $56 right here, this is a market crash. Does that make sense? Okay. This is the whole idea of bubbles. I don't want to get into something that's too confusing unnecessarily. If there's any questions about this, we can go into it. It's not really that important. It's just important to know because the solution to this, what is the solution to this? Is governments just start printing money with reckless abandon in order to keep the market from going down. Because what ends up happening is okay, let's see right here. That is a circle. Right. Okay. What ends up happening is when this crash happens, the market is going to start going down like this. The fear is going to come in, and who knows, perhaps the market will just keep going all the way down to zero. If that happens, then the economy is just going to totally crash and it's going to be a total catastrophe. So how do we stop this? We have to increase confidence. The way that we increase confidence is hand out a whole bunch of money to people for free. And what happens is when you start printing all that money, now this point right here, let's say this is $5. The market is crashing and the market is worth $5. When you print out a whole bunch of money, then automatically it's going to be worth $10 just because you had printed so much money to the economy that it doesn't, the value of this stayed the same, but the money got cheaper. But what that looks like is it looks like this. So now people think, oh, the market is going back up. And then this continues happening, and then this continues happening, and then it heals. So it's a market crash if the 5 people want their money back before the 3 of the people pay back $23. Yes, pretty much. That's a very simplistic example of how it works. It's a lot more complicated than that, but that is the basic idea of it. So if people at large ask for the money back, the bank would crash. Yes, exactly. Back in the day, this used to be called a bank run. That used to be called a bank run. I stopped sharing. They don't really do, it doesn't work like that anymore because they just print the money virtually. So it's almost impossible for the actual money to just run out. But we see that with the COVID crash, that the COVID crash was so short. Historically, that was the shortest bear market in any capitalist system's history. Or no, not in any in the United States history. That was the shortest bear market. Normally, bear markets are not any shorter than 2 years, but that one was literally like 2.5 weeks. Because of virtual banking, they can just print as much money as they possibly need. So what we're going to do now is we're going to look at subjective and objective analysis for a company. We're going to look at personalizing a company in the first step. So you guys have your 10 companies on your journal. I think somebody has their mic on. Who is that? Sheikh Uthman?
I just turned it on, yeah.
Okay. So you guys have your journal, and we're going to look at the various steps that we're going to use to determine whether or not we want to move forward with some of these companies that we picked. So we have the subjective aspect and the objective aspect of it. So the first part, the subjective analysis, is how do I know this company? How did you even find out about, oh, do you want a short break? What do you think, Sheikh Uthman? Should we give them a short break?
We can give them a short break, but here's what I want to do. There's one key point that you talked about, and I'll just share my screen here. Hold on. Can you guys see my screen here? And we'll give them like a 10-minute break, and then after they'll come back. So let's go to the market. Let's go to the market here. Let's go to the SPX. In our terminology, when we refer to the market, we're referring to the S&P. Have you guys heard of that term? The S&P. The S&P. The S&P is, so remember the term. The S&P is called the market. So when someone says the market's crashing, they're basically saying the S&P crashed. S&P represents 500 of the biggest companies in the US. So what he was talking about is very interesting here. So this over here, yeah, that was a really, really good point. So let's go back. Let's go back. The S&P starts here, and it kind of reaches up here. I'm going to show you guys something interesting. 1 year, 1 day. So we can't go back. Let's go 3 years. 3 years weekly. Okay, here. So do you guys see a crash in the market here? You guys see a little crash over here? Boom, crash. So according to what Ali is telling us, we want to know, Ali is probably going to wonder what's causing this crash. What's causing this crash? So what I'm going to do is, this happens in October, November. So October, I'm just going to quickly go to Google. I'm going to write down, why did the SPX crash? What year was it? What do you guess? What was it? Sorry, I'm just typing here.
That seems to be 2019. That looks like October.
October 2019. Okay.
End of year 2019.
October 2019. Huge crash, huge market crash happened in October. Here's why you shouldn't panic yet. And then there's articles going to be on that. Everyone's going to be talking about it. So everyone talks about the market crash. And then let me just share my screen over here with you guys so you guys can see. You guys see this? Huge market crash happened in October. Here's why. So if you're gauging, you start reading up on it, and then you'll understand why different things will take place. Because the S&Ps, I invest in some companies on the S&P, so I'm wondering. I'm like, I want to know. I want to know what goes on. The S&P or the Forbes. Of course, you can trust it. You can trust, yeah, for sure. Trust any article you read. you'll understand these points. But like, that was an article, like the Forbes article, because if something is the company is major. The company is, the S&P is huge, and everyone knows there's an imminent crash coming. And in advanced strategies, I'll teach you guys how to read charts. But for now, you see this crash here. So this is something that Ali was talking about. I wanted to highlight this. So what happens over here? What happens over here? The market crashed because there's a lot of fear. Why did the market crash? What did you guys learn from Ali's thing? This is simple ABCs. Why did the market crash over here? Because everyone wanted to buy out. There was an event, COVID. It was fear. So everyone wanted to buy out. So remember, all of those 5 people showed up to the bank and they're like, we want to buy out. You guys understand? They all wanted to buy out. So it crashed. Boom. So what did the government do all of a sudden? To help the banks out? What did they do? Same principle. Ali literally started printing money, stimulus checks, printing money. So what happened? Look at that. Look at how long it takes for this to go up. Look at this one. Boom. This is a simple idea of deflation, inflation. Deflation, you can see this at COVID. It drops, boom, and then it just starts to go up. Boom, and it goes up very fast. So clearly right now, it's at an all-time high right now. So people that are making trades on the S&P right now are very, it's a very, very high example. So this is just an example I wanted to show you guys directly looking at the charts. When there's a crash, the fear happens. When there's fear happening, everyone's still like, oh my God, sell, 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 sell. 5 people show up to the bank. We want all our money back. A bank doesn't have enough money, so it's going to crash. Market's going to crash. The government is like, help the banks out. They're going to start printing money, printing. Canada was giving CERB checks. Have you guys heard of, who's here from Canada? So Canada was giving CERB checks. They were giving money, and people who were in the market, they were like, where's Canada getting all of this money from? People that were into economics, they're like, this is going to crash. This is going to crash. So what's happening in the market right now of Ali is thinking the same thing. I'm thinking, us financial analysts, we're thinking exactly the same thing. This is an all-time high, and this is a result of inflation. You guys understand if I said that? This high here is a result of inflation right here. What's going to happen? What's going to happen? Like Ali said, eventually people are going to realize that. And when people realize it, what's going to happen? They're all going to go back to the market and they're all going to sell. When they're all going to sell, it's going to drop again. It's just going to drop. Hey, we're waiting for an imminent crash. Hey, I know, but that's what happens. It's just completely stupid, but that's what happens. It's going to come down. Yeah, people are predicting 2021, 2022. You just start, you just notice it. So now someone like Ali, he knows that. What does Ali know? Ali knows that when there's a crash, government's going to jump in. Am I right or wrong? So as the market is going up, everyone's like, oh my God, invest, 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 invest. So here's an amateur investor is going to come in over here. He's going to say buy low. It doesn't matter. Ali already knows that the S&P low is here. He's already made that determination a long time ago. He's made that determination here. So people are going to invest over here. That's where they're going to invest. And then all of a sudden, Ali as a proper investor, he knows that there's a fear going to happen in the market. He goes to the market, pulls out. Warren Buffett goes and pulls out. Everyone goes and pulls out. The second they start pulling out, boom, it drops because they all pulled out. Everyone else was waiting. And I'm going to teach you guys in advanced courses. I teach you guys how to see this. I showed this to my other advanced students, and I'm like, in February, these guys would have all pulled out. If they didn't pull out, there wouldn't have been a crash. But Ali knows, pull out, basically sell their shares. Sell their shares. Ali owned like 1,000 shares. He's going to sell them all, collect all the money. So he collects money over here. I'll answer that question. And then the market crashes. He predicted the market crash. He knew from beforehand the market was going to crash. I'll explain that to you in advanced classes. I teach you guys how to predict it. And then when it reaches down here, Ali automatically knows. Oh, completely. Ali automatically knows what? That there's going to be an inflation because the government are weird that way, right? The government's going to print money because there's fear of humans here. Now there's fear of the market here. Government's going to crash also. So Ali goes ahead and jumps in and buys over here. And the governments are stimulus checks, CERB checks, everything, just giving money as if it's someone no, and all of a sudden it goes up. Boom. Just ride that wave. Just enjoy it while it lasts. This is your entry point. Normally people do it differently. People are going to tell you the difference. What are normally people are going to tell you what? We're going to buy over here because it's going up. What did Warren Buffett say? No, we're not going to buy here. We're not going to buy here. We're not going to buy. We're just going to chill. We're just going to wait. So are we selling and buying as a market changer? We're buying low and holding until for the long term. So that's the point we're gonna be talking about, because if you know that there's a event going to come up, let's just say you knew that there was an event that was going to happen here, Amin. Would you sell if you knew there was an event going to happen here? You knew beforehand. Of course you would sell. So that's kind of what it is. Ali knew. Ali automatically knew he was going to sell. The market was going to drop. Now you guys are probably wondering, how did Ali know, right? How did Ali know that it was going to crash? Well, he knew. He knew in February it was going to crash. He knew in February it was going to crash. Well, let's see when he actually knew. Look at that. Ali, what was the day here? February 24th. February 24th here. It's a metaphor, yeah, but February 24th, he knew it was going to crash. So February 24th, he would pull all of his money out. And when did the big crash happen? In March. He would have literally pulled out way before the time. And but we'll get to all of this anyways. But let's look at the child. You know what we're going to do? I'm just going to go through a few questions, give you guys 10 minutes, and come back and finish off that homework, all right? So the worst time to buy would be when of course, worst time to buy. That's like, why would you do that? The crash you are showing in the middle, how to make an analysis. It seems like there have been multiple drops. It doesn't matter. These little drops, we don't care about these little drops. These little drops, we don't care about those little drops. We really don't care about them. These little tiny drops, These big drops, you know beforehand they're going to drop. But this is only the market. We're looking at the S&P. Which one are you talking about?
I think she's talking about the COVID drop. She wants to know, at what point do you buy in? Like, how do you know the bottom?
Oh, because you already have a buy price.
What I think you are missing, Mediha, is that we don't buy stocks based off of, just whatever the market is doing is high or low. You're going to look at an individual stock and you can determine this stock is worth this much and I'm only going to buy it at this price. And that's it.
That's the example that I was giving. Ali's going to go into Apple and he's going to be like, I'm buying Apple at $50. And Apple's going to be like, okay, cool. But compared to you guys, you'll be like, that's so weird. How are you going to pull that off? We know the market. When you know the market, you're going to go and dictate your price. For example, how many of you have children over here? You're going to go to Children's Place or Carter's or whatever, and you have a little t-shirt that costs $47. Are you going to buy it? No, you're going to be like, this is worth $3. I'm going to buy it only at $3. When you understand the company, you dictate the price. Does that make sense to everyone? That's what we're going to do. So we don't care about the crash. Oh, crash is happening. Okay. Even if Ali's price was like $2,000, he won't buy it. Even if it was a low crash, he still won't buy it. These are really, really good questions. By next Sunday, when you learn valuation, we're going to be teaching you what is your buy price of the company. So you're not going to buy it at anything higher than that. You're not going to, Joe, just because people are buying doesn't mean you're going to buy. Oh,
If you
yeah.
if you believe a sandwich is worth $5, like, okay, I always buy sandwiches worth $5, and then one day the price of the sandwich goes up to 50. It doesn't matter. You're not going to buy it. And then even if there's a crash with the company and the prices go down and now the sandwich is worth $15, you're just not going to pay that much for a sandwich. You know, a sandwich is just not worth that much. You're going to wait as long as it takes for that company to start selling a sandwich at $5, and only then are you going to buy it.
All right. How do we know how to set it up? So over the next, again, this is the first day of class, and this one more hour, and then we're done. But by the end of the fourth week, you'll know exactly what. Go ahead, Madhya. You can come on the mic. Give me an example. Come on the mic. I do need to give you guys a break.
I don't know if you guys can hear me.
Yeah, we're good.
Okay, so a few years ago in Chicago, there was a huge market, I don't know how to call it, unpredictable thing going on. So it was for a long time, the taxi were selling for only $50,000 for years, okay? And now all of a sudden, I don't know what happened, but the price went up. It first went up for $90,000. Then a few months later, went up for $150,000, then $200,000. It reached within less than a year, a price at $350,000, less than $250,000, more than $250,000. And then whoever purchased it at 50 at that time, within a year, they actually had so much money. So that's what I'm saying. Like in the same way as it goes down, it keeps crashing, or goes up. Well, what is the point of your making decision? Okay, this is the best time I should invest or sell or buy. So how do you make that decision?
That's a good question. Your research is going to do the following. We're right now, this whole weekend and next weekend, we're going to teach you how to research, and that research is going to give you the following. You will have a buy price and you will have a sell price, and you don't care about anything else. In other words, if the company that you want to buy it's at the buy price, you buy it. And if it's at the sell price, you sell it. Doesn't matter what's happening in the market. You'll totally phase out from the market.
Yeah, but Warren Buffett said, I don't mind waiting indefinitely, and then I like to buy big. You know, there were a lot of people that I knew, they sold their, taxes at price of 150, and then they regretted for not waiting to make more than $250,000.
You realize that's gambling, right?
So is this not the same?
We don't gamble. We don't gamble. We already know. I already know my buy price for Apple is this much and my sell price is that much. I'm going to buy it there. I'm going to sell it there. I don't care about what happens in the market. That's the difference. Don't worry. These questions will be answered though. Take 10 minutes. Come back at 20. So come back, return at 1:20. Return 1:20 Mountain Time, and then we're going to get your homework done. Inshallah. I'm going to have to open up some paperwork. So we will learn. Yeah, of course you will. Clearly. Yeah, you're going to learn all that. Cool. So go take 10 minutes, and I'm going to be here. And Ali, what information do you need from me? Because I can pull up information real quick. So we were looking at market cap and stuff, right? You need all that stuff.
Let's see what we're looking at. We're looking at how do I know this company? Where's it located? What connection do I have? And then the three peers. The three peers, I think they're going to have to kind of determine that market cap, and then the previous year debt is what we're going to need.
Okay, so what I'll do is those numbers I can pull up really quickly. So I'm going to give them those numbers this time. This time it's going to be hard for them to decide or to find it, right?
Yeah, because they don't even know how to look at a 10K or where to look.
Yeah. So I'm gonna give them the numbers for that.
Zeddy is asking, is there new homework? Yes, there's going to be a little bit more to the homework that we're going to talk about after the break, inshallah.
Yeah, and we're gonna give that to you guys right now. So we're gonna be doing that with you guys in class until the end of the class. So I'm gonna open up my toolbox here so that I can easily get those numbers. So if someone says, "What's the market cap for this company?" I'll be like, "It's this much." I'll be like, "Okay, cool." And then right away we're gonna be able to like delete a lot of their companies because they might not even exist, right? Hold on. I'll come back in 10. Yeah.